May 6, 2010. 2:45 in the afternoon. Accenture, a real company with billions in revenue, trades for 1 cent. A few seconds later, another stock trades at $100,000 a share. Nobody typed those prices. Nothing was hacked. And here's the part almost nobody explains. It was not caused by too much selling. It was caused by something disappearing. Something invisible that sets every price you will ever get. By the end of this video, you'll be able to check it in 3 numbers before you ever click buy. But first, something strange. Markets don't get dangerous when they go quiet. December 2018. The S&P 500 future, a contract on the famous index, and the busiest stock index market in the world, traded 65% more than normal. And in those same weeks, the amount you could actually buy or sell into fell by 75%. The busiest market on Earth and the thinnest at the same time. Which means the question everyone asks, how much does it trade, is the wrong question. So here's the right one. This is the ladder, the order book. If you've seen our earlier videos, welcome home. If not, you need nothing but this ladder. Every row, every rung is a resting order. Someone who already said, I'll buy this many at this price, and left it waiting. Volume is the trades that already happened. It's the past. Liquidity is what's still waiting on the rungs. It's the future. And the official definition is simple. Liquidity means you can trade real size quickly without moving the price. Big markets aren't the ones that trade a lot. Big markets are the ones where a lot is waiting. Check number 1, the spread. The gap between the best buyer and the best seller. That gap is the toll you pay to trade right now. Buy at the higher price, sell at the lower one, and a round trip costs you the difference even if the market never moves. In the S&P future, that toll is 1 tick, the smallest step the price is allowed to move. 1 tick here is $12.50 per contract, the unit this market trades in. That's about 0.02% of the money you're moving, one of the tightest tolls in any market on Earth. In a thin market, the toll is several ticks wide. You're paying more just to walk through the door. But the spread only tells you the price of the door. It says nothing about how many people can fit through it. That's check number 2, depth. How much is actually waiting on each rung? On a calm day, the S&P future has roughly hundreds, sometimes thousands of contracts resting near the current price. Now watch what a market order really does, the kind of order that says, fill me now at whatever price is there. It doesn't push the price. It eats. It takes everything waiting at the best price. If it's still hungry, it moves to the next rung. And the next. The price didn't move because someone was angry. The price moved because the order ran out of things to eat. And depth is where markets that look identical are not. Same index, different contract, a smaller sibling of the exact same S&P future. Built for sustainable investing funds, with about 10 contracts waiting at the top. 35 across the first 3 rungs. The exact same order that a deep book absorbs without blinking, rips straight through this one. Even the famous Nasdaq future is far thinner per rung than the S&P, huge volume, thin rungs, which is exactly why it jumps harder. Volume didn't protect you. The rungs did. But here's the thing about those rungs. The book is not a fact of nature. It's a choice. Every row is a person, or a machine, volunteering to catch your order. And volunteers can change their mind. Watch the ladder in the minutes before a Federal Reserve announcement. It empties. Measurably. Researchers found the effect is strongest in this exact market. The book isn't broken. The volunteers step back, because catching orders seconds before big news is how you get run over. The emptiness before news is not a glitch. It's fear priced in. which raises a question we'll come back to. Who are these volunteers, and what happens when one of them refuses to move? Check number 3, the refill. Across electronic markets in general, not just this one, take a bite out of a healthy book, and it heals. The spread snaps back within about a second, and half the missing size is typically back in around 20 seconds. Fully back. Here's the honest number. In more than 60% of cases, never. Liquidity is not a tank you drain once. It fades, it returns, and sometimes it just doesn't. Which brings us to the trap almost every beginner walks into, the clock. The S&P future trades almost 23 hours a day. But at 3 in the morning, the crowd is gone. Volume runs at roughly a tenth of the day session, and the rungs are sparse. August 5, 2024, a shock out of Japan landed on exactly those thin overnight books. Japan's market had its worst day since 1987, and futures gapped through the night. Same market, same screen. What changed was the waiting. Now you can read May 6, 2010, for real this time. That morning, before anything crashed, the buying side of the S&P futures book had already thinned from about $6 billion to under $3 billion. The volunteers were leaving. Then one seller began unloading 75,000 contracts, around $4 billion, into that thinned ladder. The order ate the first rung. Then the next. Then nothing to eat. Those 1-cent prices. That's an order falling all the way to the last rung of an empty book, a leftover placeholder someone parked far below, never expecting it to actually trade. And the $100,000 prices. The same thing on the other side, sell placeholders parked absurdly high. The market that afternoon didn't fall through sellers. It fell through empty space. So the sentence from the start means more now. It wasn't too much selling, it was the waiting that vanished. And that's the whole model. 3 checks, any market, any size. 1. How wide is the toll, the spread? 2. How much is waiting, the depth? 3. Does it come back when it's eaten, the refill? And those volunteers? Mostly professional market makers. But one honest warning, the latter can't tell you which rows are whom or why they're there. Some of the biggest orders hide their true size on purpose. And sometimes price slams into a wall that refuses to break. No matter how hard everyone buys, that's called absorption. So here's the question, what should we break down next? Absorption, the wall that won't break. Icebergs, the orders that hide their true size. Or pulled liquidity, the walls that vanish before you touch them. Tell us in the comments. The one with the most votes becomes the next episode. Until then, liquidity is the reason the price you see is not always the price you get. We broke that one down in our slippage video. It's on screen now. See you on the ladder.